Hello everyone. In today's video, we'll be discussing about investment appraisal techniques. Now, as a role of a finance manager of any organization, it's to evaluate the investment opportunities for that organization. And for that evaluation of investment opportunities, we use something called as investment appraisal techniques. Now, these investment appraisal techniques are broadly classified into those which are basic, and that's what the content of today's presentation would be all about. And you also have some techniques which we call them as discounted cash flow investment appraisal techniques. Now, the difference between the basic ones and the discounted ones are that the basic one will not consider the time value of money, as it's a concept in the financial management that if we have money today, it will be more worth as if that same amount of money you will have, let's say, after 2 years or 3 years. So in this case, $1,000 can buy you today will not be able to buy you that same stuff after, let's say, 2 years, because that's what the concept is, that money has a time value. So money right now will be of more worth than what you will be getting from that same money, that same $1,000 after 2 years or 3 years or even 5 years. So the basic investment appraisal techniques don't consider the time value of money, whereas those techniques, which we call them as discounted cash flow DCF investment appraisal techniques, considers the time value of money. Now we have two basic investment appraisal techniques, which I will be exploring them in today's video. And in next video, we'll be talking about discounted cash flow techniques. So the basic ones, what we have are return on capital employed and the payback period. And when we go in the discounted cash flow techniques, we'll be considering about net present value, internal rate of return, and discounted payback period. So let's talk about return on capital employed. Now, when you talk about return on capital employed, it's actually a formula which tells you that how much profits you're making from an investment. It's in a percentage form. So the formula what you will be using in your exams would be that you have to consider the average annual operating profit from that investment divided by the initial capital cost, or you can even take the average capital investment. Uh, in this case, the question will tell you that either you have to use your initial capital cost as the denominator or the average capital invested. So in case if you have uh, got the question based on the average capital investment, so that's the formula you're going to be using, which is initial investment plus the scrap value. You add them together and then divide by 2 to get the average. Now, I will explain you the application of ROCE, or you can even call it as accounting rate of return, with the help of a question. But before that, let's see that when an investment manager will proceed with that investment. So if the calculated ROC is above the rate what is being decided by the management, which we also call as the hurdle rate, the project should be accepted. So let's say that the management wants to do a project which shows at least 20% ROCE, and the investment which you're considering shows an ROC of above 20%, in that case, you have to say that based on this, it is financially acceptable to proceed with this investment. However, if the ROC calculated by you is below the hurdle rate, you will decline for that investment opportunity. Now, here we have a question. Now, a project involves an immediate purchase of an item of plant costing 110,000. It would generate annual cash inflows of 25,400 for 5 years starting in year 1. So this project, what we are considering over here, involves an purchase of a plant, a machinery, and it will cost the company 110,000. It would generate annual cash inflows of 25,400 for 5 years. So in terms of cash flow, you will get 25,400 for all the 5 years of the project of the life. The plant purchase would have a scrap value of 10,000 in 5 years when the project terminates. So once you are done with the project, you can sell the plant for 10,000 and that's what you will be receiving. Depreciation is on a straight line basis. Now you need to consider this, that when you're finding out the ROCE, we are not interested with the cash inflows. What we are more interested is in the profits of that project. Okay. So in this question, as you can see that they have provided you with the annual cash inflows. So what I have to do is that I need to convert this figure into the profit figure. And how am I supposed to do is through this formula, which is profit plus non-cash expenses like depreciation, and you will get your cash flow. Okay. So now before I move up into the further calculation part, the requirement of the question says you that you have to determine the project's return on capital employed first using initial capital cost and then through the average capital investment, right? So now we do have the cash flows over here, which is 25,400. But what we need to do is that we need to convert it into cash flow. And for that purpose, I'm going to calculate the depreciation. Now, as the depreciation in the question is on a straight line basis, so you can take the cost, which is 110,000, minus the scrap value, which is 10,000. You get your depreciable amount, which is 100,000, and you divide by the useful life of the asset for which the business is going to use it, which is 5. So hence it gives you an annual depreciation of 20,000 per year. Now, once you have got the depreciation figure, you know that your if you shuffle this formula, you can get your profit. So the cash flow minus the depreciation will give you your average annual profit. So 24,400 minus 20,000 of the depreciation, you get an average annual profit of 4,400. So if you see that I need to find out the profit. So in this case, the depreciation would be deducted from the cash flow so that you can get your profit figure. So 24,400 was your cash flow figure given to you in the question. 20,000 is the depreciation, which I calculated right now. And hence the profit, annual profit or the operating profit, which is before the interest and tax, is 4,400. Now, if I have to use the initial capital cost to find out the return on capital employed, I'm just going to simply divide it by 110,000. So 4,400 divided by 110,000, you get 4%, and that is considered to be your return on capital employed based on initial capital cost. However, in the next part of the question, it was asked using average investment. So for average investment, you have to take the initial capital cost, which was 110,000, and the scrap value, which is 10,000. So this gives you 120 in total. Divide by 2, you get your average investment, which is 60K. So using again the same profit, 4,400 divided by 60,000, investment, you will get a return on capital employed of 7.33%. So this is one of the drawback, which I'll be explaining you later also, that there's a lot of subjectivity when it comes to the calculation of return on capital employed. I mean, if you change the investment amount, it can radically change your return on capital employed. Now, here we have a different question. The difference between the previous question and this question is that in the previous question, you were getting cash flows in annuity. You were getting same cash flows every year from the project. But in this question, you can see that this project requires an initial investment of 800K and it earns net in cash inflows as follows. So you see it's 100, 200, 400, 400, 300, 200, and 150. So the cash inflows over here, the net cash inflows over here are all different. They are not in annuity. They are not in a constant amount. Okay. So that's the difference between the previous question and in this question. So most likely in the exam, you're going to be getting questions where the cash flows are different. And again, these are all cash inflows, but you remember that the formula to calculate the return on capital employed was talking about profits. In addition, at the end of the 7-year project, the asset initially purchased will be sold for 100K. So here in this question, it has a scrap value of 100K. Now you have to determine the project's return on capital employed using initial capital cost and the average capital investment. So what I'm going to do to solve this question is that I need to first add up all the cash inflows which I'm getting from this project for the 7-year period. So if you add up 100, 200, 400, and again 400, and again 300, 200, and 150, the total cash inflows what you will be getting would be 1,750,000. So that's 1.75 million. And because the life of the project is 7 years, so I can say that the average annual cash inflows are 250,000 per year. Okay, so you add up all of the cash inflows and you divide them by the number of the years of the project so that you can get your average annual cash inflows. And now once we have the average annual cash inflows, we can just simply deduct the depreciation amount to get the profit, the average profit. So for annual depreciation, you already know the formula, which is cost, that was 800K, minus the residual value, which is 100K, or the scrap value, and you divide by the number of years of the project, which is 7 years. Hence, it will give you an annual depreciation of 100K or 100,000. So the average profit would be 250. That was your cash inflow minus the depreciation charge of 100K, and you get 150 average profit from this investment over a period of 7 years. Now, if I use initial capital investment to calculate the return on capital employed, I'm going to take 150 divided by the initial investment amount of 800, and hence it gives me an return on capital employed or accounting rate of return of 18.75%. However, if I'm using the average investment, in that case, I have to take the original cost, which is 800, plus the scrap value, which is 100. It gives me a total of 900. And then if I divide by 2, I get the average, which will be 450K. So once we have the average investment, your profit will remain same, which was 150. Divide by the average investment of 450, and hence you get an ROC of 33.33%. So you can observe it, that if you're doing with the average investment, the ROC will be higher than what you would have used as initial capital cost. Now, the initial capital cost will not only include the cost of any new assets which you have bought. There might be, for a project, any existing asset which you might have to use for the new project, which you as a financial manager are considering. So in that case, we have to take their carrying value or their net book value for the purpose of initial capital cost. So if you are buying a new asset, you can just take the purchase price. But in case if you are using an existing asset for the purpose of the investment, you can just simply take its net book value and use that figure for the calculation of return on capital employed. Now, the questions what we didn't involve working capital investment. So when you're doing a project, it might also require investment in your working capital apart from your non-current asset investment. So if that's the case, if that's also required, you also have to include that figure in your initial capital cost. Likewise, so far we were talking about only tangible investment. However, there might be intangible assets investment also, and that might also be part of your initial capital cost. However, you do remember that as we were charging depreciation on tangible asset, we also have to charge amortization on those capitalized R&D expenditure, and that will also be deducted from your cash inflow in order to get the correct profit, which you will be using in the calculation of return on capital employed. Now, this is very important from the terms of MCQs, which you might face in section A of your exam, that what are the pros and cons of using ROCE. So let's first dive into the the positive sides of using ROC as an investment appraisal technique. The first one is that it is easily understood and calculated. So there was no rocket science for you guys to understand ROC, because it's just like an accounting ratio percentage. It's easily understood and it's easily calculated. You just have a very simple formula and you use that formula and you can figure out your return on capital employed. And the what increases the easiness of using this method is the data what you require to calculate ROC is readily available from the financial statements of the company. I mean, from the income statement, you can identify that what's the profit of this project, and from the balance sheet, you can easily identify that how much money was required to invest in this project. So there's no problems in finding the data. What you will later on figure out that when you're doing discounted cash flow techniques, so it's quite difficult to obtain the data to evaluate the project. And another good thing about return on capital employed is that you express it in terms of percentage. So it's quite easy to make any non-financial manager background also this percentage. So as it's quite easy to explain a person, your manager who's not from the financial background, because ROC is in a percentage. Now, the negative sides of the return on capital employed. Now, as we said at the start of the video, that it ignores the time value of money. So as the payback period. So, but you have more advanced techniques which will consider the time value of money. Now, profits can be depending on different accounting policy. It might depend on your different depreciation policy, for example. So the profit figure is open to manipulation, and it has a lot of subjectivity. So there is no hard and fast rule to get your profits. Profit changes with respect to whatever accounting policies and estimates you're using. Okay, so we don't get a perfect investment signal that whether we should be investing it or whether we shouldn't be investing it. It doesn't let you know that how much increase is in the wealth of shareholders by doing this project. Like further in discounted cash flow techniques, when you will be talking about net present value. So let's say if the net present value of the project is 500, so that 500 actually tells that this is the increase in the wealth of shareholders. Because as a financial manager, your purpose is to help the investors to increase their wealth. So this method of investment appraisal technique doesn't fulfill that purpose of a finance manager to increase the wealth of the shareholders, to do those investment projects only which will actually help the investors or the shareholders of the company to increase their wealth, their investment. This point again, as I told you, that we don't get an indication of investment. We don't get a definite investment indication that whether the manager should be doing this project or should not be doing this project. At the end of the day, the financial managers still have to use their own judgment before they decide that whether we should be doing this investment or whether we should simply decline and reject it. On the other hand, NPV, net present value, will give you a clear signal if the NPV of the investment opportunity is positive. So if the net present value of your investment is positive, you simply go on with that project. If it's negative, it's clear-cut decision, it's clear-cut signal that don't pursue with that investment. Now, the next method, the next basic investment appraisal technique, what we have is payback period. Now, what is payback period? Now, see, when you have let's say that you have a project in front of you, and you're pitching your investment plan to investors. One of the questions which you will get from the investor is the payback period. Like profit is something which comes later on. Every investor who might be interested in investing in your business plan would be interested in the payback period. So let's say if you demand $100,000 for one of your business plan, the first question which an potential investor will ask from you is that what's the payback period? I mean, forget about the profits, but just let me know that if today I invest $100,000 in your business plan, in how much period can I expect that money to come back to me? Okay. So profits are later. So every investor will want to make themselves safe. So in order to get that, they try to determine the payback. So if the payback period is, let's say, within 2 to 3 years, the potential investor might be interested in investing in your business plan. But on the other hand, if you take a much larger payback period, then a potential investor who doesn't want to take too much of risk might not be interested in investing you, because the payback of his investment is quite longer. The more duration, the more risky it is that he might not get his money back, right? So in that cases, a payback period is the time a project will take to pay back the money spent on it, the initial capital amount. So now the good thing about this investment appraisal technique is that it is not dependent on profits. It is dependent on the cash flows, because when you are studying financial management and you're talking about investment decision, we are least interested in the profits. As I already explained you, that profit is subject to manipulation. Profit is not something from where you pay the dividends. Profit is not something which you can spend further on in increasing or expanding your business. So the key in financial management decision is the cash figure, not the profit figure. As a financial accountant, you might be interested in the profit figure. However, when you are in terms of financial management, or you are a financial manager of an organization, the important figure for you would be the cash and not the profit. So this fact is one of the very strong drawbacks of the return on capital employed, which we already discussed, that that method was based on profits and not on cash flows. The rest four, you have your payback, your net present value, your internal rate of return, and the discounted payback. All of them are considering cash in their appraisal, and not the profits. Okay. So it provides a measure of liquidity. So for the investors who are concerned about the liquidity, they will be more likely interested in the payback of the investment, because they want their cash back. They don't want to be without the cash. So whatever they have invested, they will be interested to get that amount of money as soon as possible. Now, what would be your decision rule for this? Now, if you are evaluating a single project, like let's say in the question, you just have one project and you have to evaluate, you calculate its payback period and see that if it's within the specified time by the management. So let's say the time specified by the management is 3 years, and the calculation tells you that the project's payback period is 2 years. Hence, in this case, you will accept with that project. Okay. But in case if the calculation tells you that the payback of this investment will be 4 years, hence, because it's greater than the time specified by the management, you will be deciding to reject or decline that investment. However, if I have given you more than one project, or the question tells you gives you information about more than one project, let's say project A and B, obviously you will choose the project which has the quickest payback period. So depending that how the question is set for you in the exam, you will decide your decision rule. So in case if it's decided by the management, it has to fall within that period. If it's above that period, the answer will be no. On the other hand, if they have given you more than one project, you will calculate the payback period for all of the projects, and you will decide that which one has a smaller payback period. Now, again, it depends that how the cash flows from the project are coming. Are they coming in annuity, or they're coming different cash flows every year? So if the cash flows are constant every year. They are in annuity. We just simply use a formula which is initial investment and we divide by the annual cash flow. So let's see, in this question, it was an expenditure of 2 million to generate net cash inflows of 500,000 each year for the next 7 years. So today's investment is 2 million, and every year I'm going to be getting 500,000 from that investment for the next 7 years. So that makes it up to a total of 3.5 million. But what is the payback period for the project? So you have to take the initial investment, which is 2 million, and you divide by the annual cash inflow, which is 0.5 million, and hence the payback will be 4 years. So within 4 years, because every year I'm getting 0.5 million, I will be getting my 2 million back in 4 years. So now it depends on the management policy that in case if they do a project which has a payback of, let's say, 3 years, they will be rejecting this project. But on the other hand, if they have a payback period of, let's say, 5 years, then this project will be acceptable for them. Now, if you see in this question, the cash flows are not going to be even, they will be uneven. Okay, so in that case, what we do is that we have to work out the cumulative cash flows over the life of the project. Now, here's your question. You see that the investment required right now is 1.9 million, and these are the cash inflows you're getting from this investment over a period of 5 years. So, what I'm going to do over here is that I will be making a separate column over here, which I term it to be as cumulative cash flows. So let me explain you with this chart. This 1.9 million is my investment. The next year I got 300. So fine, I got my 300. So still I'm remaining with 1600. The next year again I got 500. So still I'm left out with 1100. So this takes at least 2 years so far. Third year, I got 600. So still I am left out by 500. But if you see in the fourth year, I got 800. And hence now I have got my complete amount and I still have made an additional of 300. Okay. So 300 and then again you got 500. So the total what you earned was 800 basically. But I'm not considered about that. I'm considered about my payback period. So it took me 3 years, somewhere between 3 and 4 years actually. So how are you going to figure out that what's exact? You see, you had 500, you wanted 500 more, and in the next year you got 800, right? So if you divide them 500 by 800, you get 0.625, which means that the payback was 3.625 years, right? But if you want it in months, you just simply multiply that 0.625, the decimal, with the months, 12 months, and you will get your answer in months. So that's 3 years and 8 months. So as you see that it took 3 years, right? And still I was negative by 500. But the next year I got 800. So I'm assuming that the cash flows are constant every month. So if I need 500 from the next year where I'm supposed to get 800, it will at least take me 8 months to cover that amount. Or you can even say that 3.625 years. So it depends on how the MCQ or how the question requirement is set, that either they're asking you in terms of decimal or they're asking you in terms of month. So if they ask you in terms of month, you need to multiply it by 12. Now, what are the good things about the payback period? Again, it's easy to understand and calculate. Now, that's the main reason why finance managers prefer these two methods to evaluate any investment opportunity, because they are quite easy to understand and calculate. Now, payback period will be also useful if the technology is rapidly changing. Now, in times what we are living right now, technology is rapidly changing, so we won't want to stuck our money for a longer period of time, because the technology is changing, and so we would like to do something very short, because before the technology changes, I at least want to get my money back, whatever I have invested on a certain project. So if the investment conditions are improving, obviously I need to take the opportunity of that improved economy or the improved economic condition. So when you see it's an economic growth, a lot of people will prefer to do investment which have a shorter payback period because they want the money back again as soon as possible so that they can reinvest that money as the economic conditions are growing and are preferable for investment. The sooner the money you get back, I mean, it's up to the finance manager that they decide to give the dividends. But in case if they don't give the dividends, they have the money to reinvest it back again in the business, and it will help the company to grow rapidly. So if you give the dividend, obviously, then there is no chances of growth. But the sooner you get the capital amount back from a project, you will be in a position to invest in B project because the payback was quite lower. In case if the payback will be higher for a high number of years, then you are stuck in that for that number of years, and it will have no opportunity for you to grow. Risk. The sooner you get your money back, the lesser the risk you face. And there won't be any liquidity problem because the sooner the money you will get back, it will help you to fund your operations, and you can also decide to invest it somewhere else. This point we already covered up that the payback uses cash flows and not accounting profit. Hence, it's a better investment appraisal technique as compared to ROCE. So, in the exam, you might get a question where asking that why is payback period more preferred than ROCE as an investment appraisal technique? The answer to that question would be because the payback considers cash and not the accounting profits. And I already explained you that the problem with the profit is that it's neither used to pay the dividends, it can be subject to manipulation and different accounting estimates and policies, right? And that's not something which you spend, okay? It's just in the books. But from the finance manager perspective, we are interested in the cash figure because cash is what you take as a financing, cash is what you invest, and cash is what you pay back to your investors too, and not the profits. Now, what are the bad things about the payback period? That it ignores the return after the payback period, hence the profitability of the project. Now, just because this project had a payback period of 2 years, I chose that project. But there was another project available for me where the project payback was 3 years, right? And I didn't choose that. Now, the problem with the project, which was having a payback period of 2 years, was that after that I didn't had any cash inflows, and that was it. But in the project which I rejected, having a payback of 3 years, in the fourth year, I was having too much of cash inflows and too much of profits. So I just reject that. So there was no harm in taking a risk for one more year and get the profits rather than choosing an investment which had actually no profits overall from year three onwards. So 2 years was a payback. I got my capital amount, and that's it. After that, no returns. So the problem with the payback period is that it distinguishes between the period where you're getting your capital amount and the period which is after the capital amount where you get the returns. So that this is the problem of the payback, that it excludes the second period where you're actually getting the return. So if you are deciding an investment appraisal technique, obviously it has to consider the whole life of the project. It cannot just focus on the period where you are getting the initial capital investment amount only. Likewise, this method also ignores the time value of money. It doesn't give you any investment signal, also like ROCE. So because it all depends on what is quickest and what is the policy decided by the management. So this doesn't gives you a hard and fast rule of either to invest or not to invest. Like in cases of net present value, which gives you a clear indication of whether you have to invest or whether you don't have to invest. Right. It takes no account of the effects on the business profits and periodic performance of the project. As I already explained you that the profitability of the project is ignored. Okay. We are just focusing on the investment amount part and not the returns or not the profits or not the surpluses, what this investment is likely going to generate for the organization. Now, if you have any further questions and inquiries, please feel to email them to me at rishfaisal@hotmail.com, or you can even WhatsApp me on my number given to you on the screen. Thank you very much.